Your Social Security statement is probably wrong. In fact, I would guarantee it's wrong if you're younger, for sure. So let's dive into this. This is nuts. It's nothing the Social Security Administration is doing that's nefarious or anything like that. It's just they're dealing with projections it's just impossible to figure this stuff out. So let's go into this. All right. Look, I'm looking at this from the Social Security Office of Retirement Disability Policy, the analysis of benefit estimates shown in the Social Security statement. Now, I did all the reading, so you don't have to. But if you want to, by all means, do so. So let's start with the current statement method of estimating benefits. The statement provides personalized estimates of future retirement benefits for fully insured workers. That is, workers who have earned 40 credits in Social Security covered work. To get a credit, you have to earn $1,400.10 is one credit. So in 2020, a worker earns one credit if they make $1,410 of wages or self-employment income that they pay Social Security taxes for. All right. Social Security Administration estimates future benefits according to the current Social Security program and benefit calculation rules. Social Security benefits are based on a worker's lifetime earnings in the Social Security covered employment. The benefit computation accounts for covered earnings, again, where you pay Social Security taxes, up to each year's maximum taxable amount. Annual earnings are indexed based on the National Average Wage Index to the year the worker turns 60, which is 2 years before the earliest year of eligibility. We talked about this a million times a Sunday, so just watch my playlist on Social Security. The highest 35 years of wage index earnings are averaged to compute the worker's average index monthly earnings, or AIME. And then the worker's AIME is used to calculate your primary insurance amount, your PIA. The PIA is the initial benefit estimate before either reducing it because you took it early or increasing it because you took it later, or other offsets such as retirement earnings test or GPO. Because a worker's complete lifetime earnings are unknown until the worker applies for Social Security estimates for the benefits for the statement by projecting the worker's future earnings until retirement. Again, let me read that again because I want to be clear. Because a worker's complete lifetime earnings are unknown until you apply for Social Security. Social Security estimates your benefits for the statement by projecting your future earnings until retirement. So let's just go down here a little bit. I want to show you the statement again so you can see Wanda Worker right there. So we got this. Here's Wanda Worker. It says your payment would be about $19.71 a month. And this is dateline May 1st, 2020. Well, what's that based on? We'll go down. Retirement. Now, how old is Wanda? She was born right here. Date of birth 1980. So she's only 40 years old. Her stuff is going to be jacked. Why? You have earned enough credits to qualify for benefits at your current earnings rate. If you continue in working until your full retirement age, you'll get $19.71 a month. That's in today's dollars. Another frustrating thing. They're way underestimating when you factor in cost of living adjustments and stuff. It's crazy. All right, let's keep going. Let's get right here. All right. So let's see. So Social Security uses the past workers' earnings to project future workers' earnings by assuming that the worker continues to earn the same amount as in the prior year of the statement receipt. If there were no earnings in the prior year, then Social Security assumes that future earnings are the same as the earnings in year two. We'll talk. I'll make this clear in just a second. Just real quick. They look at they're going to say they're making the same amount of money until your full retirement age. And Wanda Worker, she's 40. They're assuming she's going to make the same amount of money she did until her full retirement age. If there were no earnings in the prior year, then Social Security Administration assumes that future earnings are the same as the earnings in year 2 years prior to the statement. So I'm going to go into this a little bit because I think this is wrong. All right, well, actually, they give us an example. For example, consider Jane, a worker with earnings in 2019 of $50,000. For her 2020 statement, Social Security assumes her future benefit by assuming she will continue to earn $50,000 in all future years. However, if Jane had no earnings in 2019, then Social Security Administration assumes that her future earnings will be the same as her earnings she had in 2018, 2 years prior to the statement receipt. If Jane had no earnings in both 2019 and 18, then Social Security would assume she had no future earnings ever. In other words, if Jane did not have any earnings in 2019 or 18, then the benefits estimate for her 2020 statement is based on the assumption she will earn nothing for all years. I don't think that's true. I'm telling you right now. And the reason I say it is because I made more than the max in 2017. And then I made $24,000 in 2018 when I started my business. My statement in 2019, which reflected my previous year's earnings of $24,000, which also presumably reflected my previous year earnings in 2018, was a significant drop. So that I tell you, man, it's significant. So I guess what they're saying is they're assuming no earnings. But what if you had lower earnings? It's interesting because I'm telling you. So I made, let's say, 135 in 2017, 24,000 in 2018. In 2019, I guess it was assumed I'd only make 24,000 until I was 67, and 19 be 2037. Yeah, I guess that's true. So that's interesting. So if you have a significant decline in earnings for 1 year, they're going to assume that that significant decline is perpetual until you hit your full retirement age. That's interesting. But if you have no earnings, nothing, they're going to assume the year that you had no earnings is an outlier, and the year previous to that, we're going to carry that forward. I didn't know that until I just read, until literally just as I was going through this video. It makes sense. I didn't realize that before. So they assumed because I only had 24,000 earnings in 2018, even though I had 135 in 2017, that I continued for 24,000 earnings forever. And of course, now that I'm making more than 24,000, my benefits statement has gone way up again. Interesting. All right. The Social Security statement, statement emphasizes the actual benefit a worker will receive may be different from the estimated benefit because of a number of factors. Your earnings may increase or decrease in the future. Yeah, imagine that. After starting receiving benefits, they'll be adjusted for cost of living increases. So that's the thing. They don't do that on the statement, so it makes the statement look inferior to, if I invested at 5% a year. Your estimate benefits are based on current law. The law governing the benefits may change. Your benefit amount may be affected by military service, railroad employment, pensions, and if you don't pay any tax, whatnot. All right. In addition, the statement asserts that the benefit estimates are more accurate for older workers who are closer to retirements. And one of this paper's goals is to examine that assertion. All right, so I want to read this here. Profile workers with 2 consecutive years of no earnings. We started by examining the assumption that the person who does not work for 2 years prior to the statement will have no future earnings. We use CWHS. Let's see what that is. I forgot. 1 second. CWHS is the continuous work history sample. So CWHS says that's the estimate. Their continuous work history sample. So let's keep going down. All right. So that's what. Let me just get rid of that 1 second. We'll just boink, knock that out. All right, cool. All right, so we use CWHS earnings record of workers born in 1933 to 1953 who had a year of earnings followed by at least 2 consecutive years of no earnings and who lived until at least 62. All right, so then we identified men and women who had earnings in any of the 5 years following 2 consecutive years of not making any money. All right, so what they're going to show you is that you'll see percent of workers with earnings in any of the 5 years following the 2 years they did not have any earnings. So again, if you made no money in 2019 and 2018, your 2020 statement will reflect that they don't think you're going to make any money ever again until your full retirement age. And yet the percentage of workers who actually had earnings in any of the 5 years following those 2 years of no money is high. It's 2/3 of men. And I mean, look at that. So if you're 50 to 54, almost half the men had earnings. If you're 50, 40, I mean, you can see it's half to 2/3 the men had earnings even after 2 years of not having any earnings. Women, it's almost the same thing. Now, their earnings wasn't much, all right? I mean, it wasn't much, but they did have earnings. So the idea that if you have 2 consecutive years of no earnings, you're not going to make anything is simply, that's bad. Mean annual earnings in the years before 2 consecutive 0 earnings years by sex and age. All right, so let's check this out. All right, so we're going to look at 40 to 44-year-old men. The mean annual earnings 2 years before they didn't make 2 years of money was $18,000. All right, in the 2 years before they made no earnings for 2 straight years was $18,000. So now 40 to 44. After they had 2 years of no earnings, i.e., they got laid off or something like that, and now they found a job, they're making about a third of what they made before. So while it's a significant drop off, they're still making money to qualify for full Social Security benefits. That's just a fact. In fact, the women actually, the mean annual earnings were $9,000, and they're making about half the 2 years after. So again, in this case, a guy who's 40 years old was making $18,000 a year, means average, all right? Then he had 2 consecutive years of no earnings, and then the Social Security statement says, oh, no earnings, you'll never have earnings again. And then lo and behold, he makes $6,000 in at least one of the 5 years after the 2 years of no earnings. Pretty significant. All right. Next, we measure the career average earnings through age 62 of men and women following 2 consecutive years of no earnings. All right. Percentage of workers with any earnings through age 62 after 2 consecutive years of 0 earnings and mean annual earnings in those years. So you can see that same guy now, 74% of men and 78% of women who had no earnings for 2 consecutive years, their mean annual earnings after that were $14,000 and $10,000 respectively, which is within 75% of what they were making before they had those 2 years. All right, let's keep going down. All right, so we're going to look at this. Accuracy of the current state. And that's just with people with no earnings. Trust me, we're not even halfway done yet. The CWHS sample for this part of the project consisted of workers born from 1940 to 1946 who lived till at least 62. In 2015, members of the sample were aged 69 to 75, so their entire pre-retirement earnings history was known, and any corrections to past earnings would have already been made. Table 4 shows our finding of the accuracy of the statement estimate method compared to the actual PIA for workers receiving a statement at age 25, 30, 35, and you can see that. Results over 5 different thresholds of accuracy. So benefit estimates using statement method, percentages within various thresholds are different from the actual PIA. All right, so let me explain this. Well, actually, let's go back to you're 40 years old again. We're going to say you're 40 years old, all right? You're 40 years old, and your statement at 40, what is it in terms of we fast forward to your actual benefit? What's the likelihood it was anywhere near spitting distance? And it's ugly, man. So here, you're 40 years old. Percentages of projections to within 10%, only 45% of the statement that you received when you're 40 were within 10% of your actual benefits. Percentages of benefits within 20%, only 61% were within 20%. That means 40% were beyond 20%. And you think about it, Social Security, we'll just use the average, you're only getting $1,500 a month. So 20% of $1,500 is what? That's $300. That's $300 difference. And at 25%, 35% of the statements you received as a 40-year-old was off by 25%. So the statements you get as a 25, the vast majority are way out of whack. The statements you get for 30, well, not anywhere near half get an accurate statement. The statement you get with 35, the only time you get within half is when you're 20% off. It's crazy. So 20% of only a half of the people at 35 years old have a statement that turns out to be within 20%. That's it. Now, the older you get, the more consistent it is. You can see if you have 10%, so you get 86% of people 55 years old are only 10% off of their Social Security estimates. And that's simply because the older you get, the more work experience you have. I'm just telling you, so the more numbers we already have to calculate. So the younger you are, the less you can rely on this. In fact, I would say you shouldn't even rely on the Social Security statement. All right. Table, in general, not surprisingly, we found that the current statement method was less accurate for younger statement recipients and that the accuracy increased with recipient age. For example, just 14% of the benefit estimates were within 10% of the actual primary insurance amount for recipients aged 25 compared to 86% with those aged 55. And the pattern held across accuracy thresholds. Benefit estimates using the statement method, percentages within 10% of actual PIA by sex, earnings level, insured status, and statement age. Okay, so here's our 40-year-old guy. For a man, 55% were within 10%. If you didn't make much money, only 44% were accurate within 10%. That's crazy. Now, if you made a good amount of money, 82% were accurate. And that makes sense. The less money you make, the more volatility in your earnings, we think, right? And so the more volatility your earnings, because you might make more, you might not, we don't know. But the more volatility your earnings, the harder it is to estimate how much your future earnings will be. The more money you make, though, the more you're locking in those higher rates in terms of your estimated earnings, or not estimated, your index earnings. I don't want to get too deep in that, but just again, the more money you make, it's a locking in for future benefits. I cannot stress this enough, which means other lower year earnings will just be washed out because you only get 35. I know that's confusing. I've done other videos on this. All right, anyway, and insured status, not insured, that means you don't have 40 quarters. So you can see right here, though, the lower the earnings and the younger you are, the less likely your benefit is going to be correct. And that's most people. Again, we found that statements are less accurate for younger workers, women, and workers with lower lifetime earnings. Table 6 reports the percentage of benefit estimates that underestimate, overestimate, and accurately project the actual PIA within 10%. Here's a 40-year-old guy. 32% the benefits are underestimating. 45% are estimated correctly within 10%. Not correct, but within 10%. And 23% are overestimating. If you're 30, 54% of your benefits are underestimated, and only 19% are overestimated. We found that again, younger people are the ones who are not going to have their benefits reflected correctly. All right, let's see. I want to show a couple things here. The first approach, adjust the projected earnings. Okay, I want to show you something I thought was interesting. Let me pause real quick. There's a couple other things that will close up here. There's a study in 2019. The authors found that the distribution of earnings growth is not symmetric, with most individuals experiencing very small changes, while changes for a small but non-negligible number are extremely large. In addition, they found that increases in earnings for higher earning individuals are temporary, whereas declines are persistent. In addition, they found that increases in earnings for higher earning individuals are temporary, whereas declines are persistent, with the opposite being true for low earners, meaning the increases are persistent and the decreases are temporary. That would show you that the top 1% aren't, that has nothing to do with this, but I've always heard the 1%, we got to tax them. Look, I'm not going to get to it, but the idea that there's this 1% of people that always stay there consistently is not true, is explicitly not true. The top 1% fluctuates. Some get in, some get out. Some get in, some get out. You want to get in, and you want to do what you can to stay there, but it's tough. Anyway, they're saying again, the people who have high increases of earnings, increases in earnings for higher earners are temporary, whereas declines are persistent. So once you're making a lot of money, it's not likely to continue. Declines are persistent. But if you're in a low income, you can make higher earner, and that is persistent, with declines being temporary. Because if you're already low, the declines aren't that much because you're already low. And most likely you're going to go up again. All right, so lastly, I want to show you here too. Let's pause again. The paper has shown that the Social Security benefit estimates may not be accurate for many workers. We recommend enhancements to the benefit estimating tools available online at the My Social Security portal, including permitting uninsured workers access to the portal and increased capability for existing interactive calculators. I can't stress this enough. The paper has shown that the Social Security benefit estimates may not be accurate. What more do you need? So what are you going to do? Well, you better know how to calculate your Social Security benefits. You better understand how indexing works, the average wage index, the cost of living, how your top 35 years of indexed earnings. You better know this, because if you're planning on your retirement using Social Security numbers and you're basically under the age of 50, those numbers are just not right. They're not. Again, it's nothing nefarious, but how can Social Security, and they go into this, by the way, different methodologies and whatnot, machine learning, all this. And it's just, there's no way, because they don't know how individuals are going to change their actual data. They have no clue. They didn't know in 2017 I was going to quit my crappy old job and start my business. And they didn't know my income was going to fall off a cliff and then go back up or stay up. They have no idea. I don't have any idea. You don't have any idea. But you doggone better know, because if you're relying on Social Security to give you an estimate, especially if you're younger, you're wrong. I'd love to hear your comments. I'll put links in the show notes too. We'll see you.